Hey everyone, welcome back to another episode of Macro Now. At the beginning of May, the Federal Reserve announced that it had increased the discount rate by half a percentage point, its biggest rate hike in 2 decades. It also announced that it had begun to sell off nearly $9 trillion in bond holdings in federal securities in an attempt to bring inflation under control. So what led to this policy action? Inflation continues to stifle the economy, with the Consumer Price Index posting an 8.5% price hike in the month of March, the highest inflation rate the US has seen in 40 years. The price of gas, food, and other key necessities remains high, and Americans continue to struggle to make ends meet. Purchasing power is down, the cost of living is up, and real wages are falling as nominal wages can't keep up with rising prices. The news isn't good for American firms either. The Producer Price Index is up by 11%, as production costs continue to outpace inflation. Supply chain issues and resource shortages means that it's more expensive for firms to produce goods and get them to market shelves. As firms face rising production costs, they're passing the burden on to consumers in the form of cost-push inflation. The economy is also dealing with lingering quantity theory inflation. In the months following the COVID-19 outbreak in the United States, the Federal Reserve orchestrated an expansionary response to help prevent a full-scale economic downturn. As businesses shut down and consumerism slowed, the Fed bought up trillions of dollars in government bonds and securities in the open market, injecting huge sums of M1 cash into the money supply. The Fed's goal was to increase the volume of loanable funds available in banks and drive down interest rates, making it cheaper to borrow money and driving firms and consumers to take out loans and maintain their spending. However, while injecting trillions of dollars into the money supply would accomplish those goals, it also generates inflation. With more money in circulation, each individual dollar loses purchasing power, compounding the pressure put upon consumers by demand pull and cost-push inflation. So what's next? The Fed indicated that it intends to pursue a tight monetary policy until inflation is under control and prices stabilize. In his announcement last week, Federal Reserve Chair Jerome Powell stated that the central bank will continue to raise interest rates until inflation falls to an annual rate of 2%. Powell also indicated that the Board of Governors would like to reestablish a market interest rate of 2.5%. For years, the Federal Reserve's discount rate has been below 1%, falling as low as 0.25% at the depths of the COVID-19 pandemic. Lifting rates to a range of 2.25% to 2.5% could make the discount rate a more effective monetary policy tool in the future because it gives the central bank more wiggle room to alter the rate to stabilize the economy. With the current rate hovering around 1%, it's undeniable that rate hikes are in the works for the future. Expect the Board of Governors to announce additional rate hikes of 0.25% to 0.5% in the months ahead to help meet their target. The Fed's plan to sell securities in the open market will make borrowing money more expensive for consumers. In order to buy bonds from the central bank, investors will liquefy assets into M1 cash and hand it over to the Federal Reserve. This will reduce the reserves held by commercial banks and decrease the volume of loanable funds available to the general public, resulting in higher interest rates on new loans. Borrowing money and taking out loans will become more expensive for consumers, resulting in a decline in interest-sensitive spending. The bottom line? We're all going to pay a higher monthly interest rate when spending with our credit cards. Home loans and car loans will become more expensive over time, and college students will have to pay even more to borrow money for tuition. To avoid paying more on every dollar we borrow, we'll all rein in our spending. Ultimately, the Fed's tight monetary policy will lead to a reduction in aggregate expenditures, which should have an impact on any demand pull inflation present in the economy. Over time, bond sales should reduce the money supply and begin to undo some of the damage inflicted on the CPI by quantity theory inflation. However, these initial steps are unlikely to solve our inflationary problems on their own, and as long as inflation persists in the food and fuel sectors, Americans will continue to look for relief. As the Fed continues to pursue a tight monetary policy agenda in the months ahead, expect high prices and climbing interest rates for the foreseeable future.